Alright, let's get started. So the other day using the bond, we were able to break the bond rates. Using the coupon bonds, we are able to break it into a zero coupon bonds and thus arrive at the spot rates. Now, for example, let's say it is said that 1 year spot rate is 3% and 2 year spot rate is 4%. Right? What does it mean? If I deposit for 1 year, I'll get a 3% rate per year. Whereas if I do a deposit or investment for 2 years, I'll get 4% per year annualized. Now look at the two different investments. I deposit for 1 year versus I depositing directly for 2 years. Now let's assume the person here, he pulls out and again reinvests for 1 more year. Right? Now if these two, if the returns again between this process and this process are different, again there is a scope for an arbitrage. Someone can buy a short term and sell for long term, or buy for a long term or sell for a short term. So this possibility could very well exist. So which means whenever we are talking of two different time periods, if at all I have to remove the arbitrage opportunity, the interest rate during this period should be more similar to whatever the return would have come if the 2 year rate is this much, 1 year rate is this much. If the person has deposited between 1 year and then redeposited at whatever the prevailing rate at that time, 1 year rate at that time, versus depositing for 2 years at a stretch today, there should not be any kind of a difference. If that kind of a difference exists, again an arbitrage opportunity exists in that process. Right? So from that scenario, what we are saying is this particular interest rate, whatever is the interest rate that is going to be after 1 year, a 1 year rate after 1 year is what we are calling as a forward rate. Because that is not the rate as of today. At some time at a future date, what would be a 1 year interest rate? Depending on how I forecast that what would be that 1 year interest rate 1 year from now, the 2 year rate, current 2 year rate will be determined. See, the current 1 year rate is 3%. Now I will visualize what would be this 1 year rate 1 year from now. Probably some 5% if it is there. Then I am saying, okay, if at all there is a 2 year investment starting from now, it should be priced at 4%. Otherwise, there is a scope of an arbitrage opportunity here. So that forward rate can very well be derived from two different spot rates. Given two spot rates, I can very well arrive at finding out the forward rate between the two. Logically speaking, if I deposit for 1 year, whatever the return I am going to get is 1 plus R1. If I am depositing for 2 years, I'll get 1 plus R2 squared at the end of 2 years, because R2 is that 4% per year. So the amount which I will be getting is 1 plus R2 squared. So this 1 plus R1, whatever I get at the end of 1 year, if I deposit at some other rate, which I don't know at this moment, some F, I would get 1 plus R1 into 1 plus F by the end of 2 years. Unless this equality is maintained between these two, there is a scope of arbitrage. So that is where what we are saying is this 1 plus f or forward rate. Forward rate is the rate which is not as of today but as of some time in future. That can very well come out as 1 plus R2 squared divided by 1 plus R1. So in our example, it is directly going as 1.04 squared by 1.03. So whatever comes, and from there I can find out the f. So that is the straightforward mechanism of finding out the forward rate. Now what these people, what they have also done is, they have simplified that formula and given it in a form of a different formula. Instead of we doing this entire kind of an approach, they have made some kind of assumptions to it and got it into a more of a simpler calculation approach, where they are saying R2 is the second rate, R1 is the first rate. Like 3-year rate, if I take it as R1, this I take it as R2. So it is being said that R2 plus R2 minus R1 into T by T2 minus T1 by T2 minus T1. T1 is for 1 year, T2 is for 2 years. So just putting that stuff, it is simply saying it should be around 5%. 5% should be the forward rate. Forward rate means after 1 year, the 1 year spot rate would be 5%. Then only you can have a 2-year spot rate today at 4%. Otherwise, there could be a scope for arbitrage. See, if I say, just trying to see this. See, if I see that after 1 year, a 1 year rate is going to be only 4%. Only 4%. Now, who would really be interested to deposit the money for 1 year? Let's say right now we are getting 3%, and I assume that if after 1 year, a 1 year deposit rate is 4%. Now a 2-year deposit rate is 3.5. 2-year deposit rate right now is, let's say, 4.5%. There will be no one who would deposit the money for 1 year right now. Because even if I deposit, even if I pull out after 1 year and then redeposit for 1 more year, I will not be getting any benefit. If that's the case, let me deposit everything for 2 years. So there would be a liquidity crisis that can come up. So the rate should very well be determined that, okay, there should not be any scope for any kind of arbitrage. If it is a 2 year versus 1 year and then 1 year, there should not be much of a difference between the returns. Right? So which means in the future, if the interest rates are assumed to go up, obviously the 2-year rate should be higher, because 1 year forward rate will definitely be higher than the current spot rate. Right? So this is how we determine the forward rates, and even the forward rate, see, so from an exam standpoint, he can give a forward rate and ask us to find out the spot rates, or he can give the spot rates and ask us to find the forward rate. So this kind of an equation should suffice in terms of finding out these kind of stuff. And even valuing a bond is nothing but finding the present value of all that cash flows. Valuing a bond can be very well be done using the forward rates also, because from the forward rates you can find out the spot rates, and finding the value of the bond using the spot rates we have already seen. That cash flow we discount it by that spot rate to the power whatever is that period. Let's say if the 2-year spot rate is 5%, the cash flow at the end of 2 years is 100. 100 by 1.05 whole square. Something like that is what we typically do it as a discounting to arrive at the present value. So even if a forward rate is there, from the forward rate we can find out the spot rates, and from the spot rates we can very well do the valuation of the bond. Okay, here the other basic thing is forward rate agreement, which we'll talk about. See, forward rate itself is like the interest rate at some time in future, right? Now I may want to fix that interest rate, right? Let's say I would like to fix that interest rate. I don't know what would be the interest rate. Let's say I want to take a loan. Simpler example. I want to take a loan, but not today. I want to take after 3 months, right? Generally speaking, what would be the interest rate? Whatever applicable at that point in time, whenever I am taking the loan, whatever would be the interest rates that would be applicable, I would be charged according to that, right? But now I may, so no one can, today there may be some forward rate associated to that. Forward rate as of today is nothing but the spot rate as on that date, the expected spot rate on that date, right? So just instead of just leaving whatever is the interest rate on that date, I'll take the loan at that rate. What I can do is I will freeze that interest rate by getting into some kind of an agreement. That kind of an agreement where we are freezing the interest rate of the future. So that future interest rate we are making it fixed by getting into some kind of an agreement today. So even if it goes up or goes down, for us it will be that fixed rate itself. Such kind of an agreement is what we are calling as a forward rate agreement. So let me put a timeline. Today we are there. I want to take the loan here, right? And if I want to take the loan here, probably up to here, this is the loan period. So logically speaking, if I don't go with any kind of a protection, whatever is the interest rate that is applicable on this day, as on this day, would be charged to my loan for this period, right? But now what I am saying is I'll still take the loan from here itself, but I want to freeze the interest rate as of today itself, not waiting until this date. The interest rate I want it to be frozen here itself. So such kind of agreement where the interest rate is getting frozen for a future loan or a future transaction is what we are calling as a forward rate agreement. Now if we see this numerical also, an investor has entered into a forward rate agreement, something like this, where he has contracted to pay a fixed rate. So the interest rate is frozen. Fixed rate of 3% on 1 million based on the quarterly rate in 3 months. So the loan is taken for 3-month period. And he has entered into an FRA. So the rate he is supposed to pay is 3% on a quarterly rate. Assume that the rates are computed quarterly. Compute the payoff of the FRA if the quarterly rate is 1% in 3 months. So this is actual. This is the actual rate. Whereas he has frozen it at this rate. He said he will pay 3% only, whatever may be the interest rate. What was the interest rate? 4%. Because 1% in 3 months. So annual interest rate is 4%. Or probably we can say this person in a quarter, he will pay 0.75%. Because 3% is per 1 year. For 1 quarter, quarterly rate which he is paying would be 0.75%, whereas in the market, it is at 1%. Correct? So his benefit would be 0.25%. Getting it? The market rate is 1% for 3 months, whereas because of the FRA he has entered into, he has frozen the interest rate at 3% per annum. So on a quarterly basis he has to pay. So 0.75% is what he is going to pay. So 0.25% directly he got a benefit by getting into the FRA. Otherwise he would have ended up paying 1% on that 1 million. Now he has to pay only 0.75% on the 1 million. So he has gained that 0.25% on 1 million. So how much was the gain? 0.25% of 1 million. Okay, 0.25% of 1 million, around 2,500. That is the benefit. When is that benefit coming to him? He is actually taking the loan here, making the payment here. See, he has got into an FRA based on quarterly rate. So whatever is the quarterly rate, see, generally in the interest also, another significant thing about the interest rates is, any rate that is fixed at the beginning of the period, you will pay at the end of that period. Typically also, let's say we have taken the loan. On the day you are taking the loan, the interest is fixed. But you are not paying any money on that date. Whatever is the interest fixed today, you will pay that amount probably at the end of the month or end of the quarter or end of the year. If you have to pay it on an annual basis, the rate that is there, it's not the rate that is on the date of payment. It's on the date of agreement of the loan or beginning of the period. Every period, even if it is a floating rate loan also, the rate that is decided at the beginning of the period will be paid at the end of the period. Interest payments are always done at the end of the period. Right? So here also we are saying the FRA was agreed into here. But the interest is going to be paying here. So the real benefit is going to get only after 6 months. The real benefit is going to get only after 6 months. See, it's a the quarterly rate in 3 months. So he is getting into the FRA period is a 3-month period. So this is the FRA period. This is the FRA period. And here the loan started. At what rate? 3%. When the market rate is 4%, his loan has started at 3%. So he gets a benefit of 0.25%. When is he making that payment? He is making the payment here. This is on a quarterly basis. He is making the payment on a quarterly basis. See, there are two words here. This is a quarterly rate, which means he is making the payment. See, logically speaking, he wants a loan after 3 months. Contract begins today. The loan begins after 3 months. See, this guy has entered into an FRA where he has contracted to pay a fixed rate of 3% on $1 million based on the quarterly rate in 3 months. So the contract is a 3-month contract from today till date. So the contract is getting expired on this date. On this date the actual payment process starts, but on this he is making the rate as on this date, he will be paying on this date. So he is actually making a payment of 2,500 6 months from today, because the 3 months is the contract period. Otherwise, he is getting into an FRA because he wants to fix the future rate. Otherwise, if it is of the today's rate itself, there is no need of an FRA. FRA itself is the future rate I am fixing. What is that future rate at the start of the payment period? The start of the payment period is 3 months from now, because it's saying the FRA period is 3 months. And he would be making the payment based on a quarterly rate. Right? Because these are both are 3 and 3, you are getting confused. Probably let me create a slightly different problem. See, a person has gotten, let's say on 1 million, a 3-month FRA on a 6-monthly rate. So fixing at 5%. 6-monthly rate fixing at 5%. The actual 6-monthly rate is 6%. Now compute the. So this, when is this actual 6-monthly rate as 6%? 3 months from now, when the contract, when the loan actually begins. When it is the actual, because you have fixed it today. See, when you had taken the loan 3 months from now itself, right, on that day, probably when I move myself towards that date, I am observing that the interest rate is 6% on that day. But because I have booked it early itself, I am able to book it at 5% only. But 5% is not applicable from today. The 5% is applicable after 3 months only, because my FRA period is 3 months. After the FRA is over, the actual loan period starts. The actual loan period starts, which means the interest rate of whatever I have fixed, 5%, is applicable on that date. So my payment is 6-month payment. So that 5% is applicable instead of 6. If I had waited until that date, on that day the interest rate can be either 6% or 4%. If I wait until that day, if it is 4%, I am losing out because I have frozen it at 5%. If it goes to 6%, I am better off because I am still freezing it at 5% itself. Right? So in this case, what my actual payment will happen 9 months from today. Because FRA period is 3 months, the loan starts here, and my payment is 6 months. So I'll make my payment on this day, which is 6 months from here, 9 months from today. So the benefit which I can get as of, see, he may ask very well, what is the benefit as of this date, or what is the benefit as of this date? The benefit as of this date means I have to discount the actual payment I am doing here. What is the actual payment? What is the actual benefit I am getting? If I take it as 6%, 1% is the benefit. 1% per year. But it is a 6-monthly payment. So 0.5% per 6 months. 0.5% of 1 million. So 5,000 is the benefit I will get here. Now depending on the question whether he has asked what is the benefit as of this date, then I'll divide this, I'll find the present value by 6 months. The R 6% is the R, T is 6 months, E per RT. Or if he asks as of today, I'll discount it by 9 months. So depending on how the question is being asked, whether it is after 3 months or 6 months or at what period he wants the value, I'll discount it accordingly. But the only thing I have to be aware here clearly is, when is the payment that is actually getting done? Even in a normal loan, forget about FRA, even in a normal loan, if the interest rate is fixed today and it's a quarterly payment, your first payment will happen only 3 months from now, not today. Right? So the interest rate at the beginning of the period, the payment will happen at the end of the period. Because it's an FRA, there is a contract period for fixing the interest rate. So that period and then the actual product. It's as good as you buying the product. You know, if I'm talking of in any forward market, I want to buy a product after 1 month. That 1 month is a forward period. And then your actual product is, asset is coming into picture. The real buying or selling of the asset. Right? Here what is the asset? The asset itself is the interest rate here. Interest rate on a loan. Right? Which periods? Right. Bank is bothered. Bank is at risk. See, the individual wise, the loan taker wise, whatever is the rate that is fixed, that the, even if it is a floating rate also, I mean that's a very normal misconception people have. Even if it is a floating rate loan, the rate gets fixed at the beginning of the period. And I say beginning of the period, let's say you are doing a quarterly payment. At the beginning of every quarter, that rate would be revised. Whatever is that revised rate at the beginning of the quarter, you will pay it at the end of the quarter. I mean, it's not like your gold purchase. I mean, slightly small different stuff is, in a gold purchase, what is today's rate of gold? Something. So you will pay, I mean, the day you go into the market, you say this is the today's rate of gold, so you have to pay that much and purchase it. Or any stock market or any other market, what is the today's rate? At that rate you are purchasing. Interest rate is not like that. Okay, what is today's interest rate? Whatever it is, that is used only for fixing. Okay, the loan is fixed on today's interest rate. Your next payment is fixed on today's interest rate. So this same rate you will have to pay whenever the next payment, if it is a monthly payment at the end of the month or quarterly at the end of the quarter, but this is the same rate. Then next time, the next payment, again whatever, once you make the payment, whatever is the interest rate on that period, on that day, that would be your next revised rate. So you have to, your next payment will be based on that rate. right? So, I mean, when we say floating, it does not mean that on the day when you are making the payment, whatever is the interest rate that is prevailing, you have to pay that much rate. Then I'll wait for the interest rate to fall, and then only I'll make the payment. Why will I be bothered about making the payment when it is high or low? That would be a very difficult stuff. So it's always like the date, the fixing happens. Whatever is the agreement agreed upon, on that date, whatever is the rate, that would be fixed for that period. But for the next period, again it will get revised if it is a floating rate interest. If it is fixed, if it is a fixed rate, then for the entire period of the loan, that is the same percentage. But if it is a floating rate, means every quarter it gets revised. But at the beginning of the quarter, it gets revised. The payment will be made at the end of the quarter for that. Right? Okay. The next thing in terms of this bonds that needs to be typically understood is the concept of duration, which is nothing but the interest rate risk associated with a bond. One way is, what are your typical cash flows on the bond? This is the cash flows. C by E power RT. T is T1, T2, like that. These are the typical cash flows that are associated with the bond. Right? Now, the concept of duration, what it says is, so when these are the cash flows that are associated with the bond, the sum of all the future cash flows, the present value of the sum of all the future cash flows, is what we are actually calling as the value of the bond or the valuation of the bond, which should ideally be equal to the price at which the bond is getting sold. The sum of all the in any investment for that matter, how much will I spend today, depending on what benefits I will get from it in future. The benefit which I will get from it in future should be more than what I spent for it today. That's a simple investment fund. So what we are trying to do is, we are trying to find out the present value of all those future benefits. These are the only future benefits that I can get from the bond. I discount all of them to the present value, which will tell this is the package of all the benefits that you can get from the bond, the today's worthwise. So if I have to spend something for purchasing that bond today, I cannot spend more than that. At the max, I can spend only to that extent. Whatever are the total benefits I can get as of today, I cannot spend even a rupee more than the benefit. So the price which is determined for the bond is generally determined by this concept also. This is a valuation concept of pricing the bond. I really find out what is the value of the bond and generally set it as equivalent to the price. Now what is said is, if during the process interest rate changes, right? Okay, for you I have fixed the bond, all returns and everything are fixed. But let's say if the interest rate changes during the period, there is some amount of risk. Probably you may feel that I could have waited for some more time. Instead of investing it here, if I had waited, I would have got a better investment opportunity. Even those are treated as a part of risk itself. Loss of opportunity is also treated as a loss itself in financial world. See, it's not that my amount is fixed, right? If I get a 10% return, it is a 10% return I am getting, so there is no risk. But I am losing out an opportunity because the same bond with same kind of characteristic, probably if I had waited for some more time, I am getting it at 10.5%. That is also a kind of, but if it is more riskier, then probably we should not look at it. But if it is the same bond, same characteristics, if it is available at 10.5 at a later date. So what typically happens is, if the interest rate changes, the price at which the bond will be available also will keep changing. Because your formula of R, in the formula R changes, and if the R changes, the price also changes. If the R goes down, this will go up, the price will go up, which means the bond will be sold at a premium. If the R goes down, if R goes down, the bond will be sold at a premium. If R goes up, the bond will be sold at a discount. Right? So, with the change in R, there is a change to the price. This change, how much sensitive is the bond price with respect to the interest rate, is what is called as duration. The sensitivity of the price with respect to change in the interest rates is what we are calling as the duration. Now, if the duration of this bond is very, very high, which means the sensitivity of the price is very, very high. So I may get so it's like I am exposed to a bigger risk. If the sensitivity is very high, correct? If the sensitivity is very high, I am exposed to a bigger risk. For example, let me just try to depict that. Let's say we have a bond with a few cash flows like this. 50, 50, 50. A 3-year bond. Right? A 3-year bond in the process. And the rate today is, let me assume it as 10%. Right? If I assume it at 10%, if I want to find out what is the present value of all these future cash flows, I can discount this. This is after 6 months. Right? So I'll say e power R T. Okay, here I'll put it as 1 to 6 so that a formula becomes easier. So 50 is the benefit that I am going to get after 6 months. So the present value of that benefit is 47, assuming 10% is the discount rate. Now similarly, if I try dragging it, these are what are the benefits. The present value of the benefits. So 50, this 50 is the benefit I will get after 1 year. So today's value is 45. Equivalent of today is 45. So similarly, this 50 I will get after 1.5 years. The equivalent of that is 43 today. So like that I am trying to find out the present value of all. And using that I got, so if I want to do a proper pricing of the bond, it is nothing but I do a summation of all the present value of the future cash flows. So I will simply do a summation of all these 5, all these 6. So 993.57 should be the price of the bond. this bond should be sold at 993. Anything at above 993.57, the benefits are lesser than the cost, because this is the present value of all the benefits. The present value of all the costs cannot be more than this. No investor will agree for the present value of the cost being more than the present value of the benefits. So if it is available up to 993.57, the investors may purchase it, but anything above it, they are not willing to purchase this bond. Okay, so the proper pricing of the bond, if it goes lesser than 993.57, as we have discussed, there might be another arbitrage opportunity that could be created. People will sell this bond and buy something else, and again they will try to create an arbitrage opportunity there. So overall what happens is the price will come to this number itself. 993.57 seems to be an appropriate price for this bond. Now what I'll do is I'll try to vary the interest rates. Let's say right from 9%, or probably let me put it as okay, if I take different layers of percentages, which means in this place I want those numbers. So I'll see how the bond price is varying in all these scenarios. So when I look at this, so this is what is the bond prices for different layers of your interest rates. Now if I try to plot one graph between this, between the interest rates and the prices. Okay, if I am trying to plot the graph between the interest rate and the prices, we are getting, I mean actually it's not a straight line, it will be a small curve, right? Because it's here the period is very small period for us. It is seen more like a straight line, but let me try to Now we see some kind of curviness is coming up. It's not that straight, right? There is some kind of a curve between the price and the yield curve, right? It's not a perfect straight line. It's actually like a hyperbola, where you see a smooth curve like this. So the typical relationship between price and yield is always like a curve. Is a curve. It's actually a kind of a hyperbola. The shape wise, it comes more like a kind of curve like this, right? Now, what we are saying is the duration is nothing but if at all the interest rate is changed by some extent. Here, let's say the interest rate is changed. Let's say the interest rate is changed from 9 to 9.25%. Right? What is the percentage change in the price of the bond? That is what we are calling as the duration. So basically here, what is the percentage change in the price? If I simply see this number minus this number divided by this number, which is telling me there is a 1.6% change in the 1.64% change in the price of the bond. If the interest rate changes, let me just observe this too. If the interest rate changes from 9 to 9.25%, I see that the price of the bond changes by 1.64%. So for me, the duration actually comes out as 1.64% divided by 0.25%. Percentage change in the price of the bond divided by the percentage change in the interest rate, yield or interest rate change. So the duration in this case comes out to around minus 6.56. Generally, for the negative as a sign is ignored because for almost all the cases you will get it as negative itself. So in the regular usage sense, we'll simply use duration is 6.56. So which is the percentage change in the price to the percentage change in the interest rate. Now typically if I see, just if I observe the same fundamental here for all the numbers, the percentage change in price is this much. This is the percentage change in price divided by the percentage change in interest rate. In all the cases it is 2.25% only because we have taken it as a sequence. Now you see, the duration is like this. If this line has been a straight line, the duration actually should be equal across. If this has been a straight line, this is actually not a straight line. If this is a straight line, what you typically see is the percentage change across the page should be constant. So the duration also is changing, but in a very minute change. Now what we are saying is, this is for every 1% change in the interest rate, the price will change by 6.99%. If the current interest rate is here, for every 1% change in the interest rate, we see there will be a 6.99% change in the price in the opposite direction, which means if the interest rate increases by 1%, the price drops by 7% and vice versa. That is what a duration is telling us, right? Now, coming back to this. So, based on like this, you are finding out the duration. The other way is nothing but whatever is your calculation that is there, C by E per RT, you do a differentiation of that curve, which is nothing but the derivative of this graph. The first derivative of this graph is nothing but the duration. The first derivative of this curve is the duration. So that is where he has given the formula like this. If I just try out that, C by e power RT1 plus C by e power RT2 this is what is our original the price equation. This is the price equation. Now when I differentiate this price with respect to, so I'll take out all the commonalities. C I'll take out across. So then this numbers all will become e power minus RT1, because 1 by e power RT I am just taking it as e power minus RT. So plus e power minus RT2 without differentiation. I did not do any differentiation still. E power minus RT3 and so on. C has come out, P has come out. Now then I am taking the derivative of this with respect to the time. So what is that I am getting? Always I am getting it as, see, when I am taking the derivative e power minus RT, e power x derivative is e power x, whereas I have to take the constant out. So in all the cases, what is typically happening is I'm pulling out the constant r into e power minus RT1. Again it becomes r into e power minus RT2, r into e power minus RT3 and so on. That is the percentage change in the price. Percentage change in the price. Now what did we say? Percentage change in price divided by, so the actual percentage change in price, this is the change in price. The percentage change in price means this will come out as dp by p itself. Whenever we say the percentage change, the difference by original, that is what is the percentage change. So when I am dividing this entire thing again by the original equation, so this is actually becoming a second degree equation for me. So that is where this equation, when it is coming out, this equation, the same difference it is coming out, C by e power RT, this entire thing is remaining the same, but it is, everything is getting multiplied by its T1. T1 or C by e power RT2 into T2 plus C by e power RT3 into T3 plus so on. This entire thing you are dividing by the original price itself. dP is coming out as, in all of them, T1, T2, T3 are getting multiplied with, because e power RT1, when you are doing a derivative with respect to R, T1 into e power minus RT1, T2 into e power minus RT2, T3 into e power minus RT3, because e power x derivative is e power x itself, right? So that multiplication, the same e power RT1, C by e power RT1 multiplying with T1, multiply with T2, multiply with T3, divided by the original price itself. That is what is giving us the duration of the bond. In short, it is nothing but, if at all a question is given, the simpler way to address it is find out the percentage change in price from that example as we have done. Find out the price before, price after. Find the percentage change in price divided by the percentage change in the interest rate, which will give you the duration. So how am I interpreting, or what is the need of the duration? Let's say in some question he says, okay, the duration of the bond is, so the numerical can be like this. Duration is 7. Interest rate increased by 0.5%. Current bond price 120. What is the expected bond price? This is expected interest rate increase. So this is where the duration will help me, because duration as a definition is nothing but percentage change in price divided by percentage change in interest rate. Duration is given to me as 7. Percentage change in price is what I want to find out. Percentage change in interest rate is 0.5%. So percentage change in price will come out to 3.5%. But that would be in the opposite direction, because duration of 7 means actually it is minus 7. But usage it is used as 7 itself. So the price will come down by 3.5%. The current price is 120. I'll bring it down by, so the current price being 120, I'll bring it down by 3.5%. 115.8 would be the expected price of the bond. So that is where I will use the duration to predict the price. Duration is more talking of what is the percentage change in price for every percentage change in the yield or the interest rate. So if the yield is expected to increase by 1%, the price is expected to fall by duration times 1%. So I'll take that number and try to compute what would be the expected price, right? But here, so these are very common kind of question. Given the duration and percentage change in the interest rate, he may ask us to find out what would be the percentage change in price. He may give some kind of a price today. So, and based on that, asking us to find out what would be the kind of predicted price. Yeah, something like this. Just look at the numerical here. Yeah, there is one more thing apart from duration also. I think in this I have even added See, because the duration is actually not constant throughout. We are seeing that the duration is keeping on changing. The reason being, the original curve, the original equation, the price equation, it's actually a curve. When I differentiate that curve, we said we'll do a differentiation of that derivative of that curve. When I take a derivative of a curve, I actually get a straight line, not a point. Straight line means the value keeps changing depending on whether the line is fully sloped or flat or whatever. The value keeps changing at different points. So duration is generally not constant at different interest rates. For different interest rates, the duration also keeps changing. So if I really have to do the prediction, so because of that, what happens is, just let me try to depict slightly conceptually there. The price equation is more like this. When I am taking the duration, what happens is, it's a straight line. The duration is more like a straight line, which would typically be a tangent to the point, to the curve, tangent to the curve at some point. So this would be the line of the duration. This would be the price curve. Now what are we saying? Using the duration, we are actually estimating the price. As we said, duration 1% changes, the price will fall by 3.5% or something, and finally saying this would be the price. But what is happening because of that? If I am using duration to predict the price, probably in this interval no issues. The price and duration more or less are coinciding. The predictability will not be an issue. But if I am looking at very high interest rates, here if I want to find what would be the price, which means if the interest rate changes by 3% or 5%, what would be the price? What happens is, the duration will predict that this will be the price, but actually this is the price. Similarly, at low levels, let's say here, at this rate, what is the price? The duration is predicting this is the price, the duration line. Even the actual is also here only. So more or less, there is an accuracy in the prediction. Whereas at extremes, there will be a problem. At this rate, if I want to predict, the duration will say that this is the price, whereas the actuality is this is the price. So because of the curve versus a straight line gap, there is a scenario of the duration may not be alone sufficient to do the price prediction, because at every layer the duration is different, right? So that is where they have introduced a second derivative, which is take a derivative of the duration itself. When I take the derivative of a line, I'll get a point, which means the second derivative is just a point, and that point we are actually calling as convexity. That convexity, that's another term which is nothing but the curvature of the curve, right? The more curved the curve is, the convexity will be higher and vice versa. So I may have to add the convexity value also to typically determine the price more accurately. Duration alone is not sufficient, because duration will create gap in the price prediction. This gap is covered using convexity, right? Which is the second derivative of, which is so the definition wise also it goes as percentage change in duration by percentage change in price or percentage change in interest rate. Now, if I try to take in this example itself, let's try out the percentage change in duration. This is the percentage change in duration divided by the change in interest rate is 0.25 itself, 0.25%. So this percentage change, to what extent the duration is changing with respect to the change in price is what we are calling as convexity. Typically, when my curve, convexity is actually even a concept from physics also, when its outer surface faces the origin, we call that curve is convex. When its inner surface, if the curve is like this, when the inner surface faces the origin, we call it as concave or negative convex. In some curves in the bond world itself, we'll see they exhibit negative convexity, right? Especially the bonds with some options on them, we'll look at them. So they will exhibit negative convexity, whereas a typical regular bond, it always exhibits a positive convexity itself. So at the end, now whatever is the convexity that is given, even that convexity has to be added back to predict the price. So both duration and convexity together are helpful in determining the price of the bond, the expected price of the bond. In isolation, neither of them can solve the problem. See, duration is a good measure to predict the price. But as I said, only in a certain interval, the duration can be a very good measure to predict the price. But once it crosses an interval where the curvature is very high, the straight line may not be sufficient to do the prediction of the curve. That is where convexity will become more and more required. So when you simply look at this part, so here look at, so when I am bringing in the convexity, see, just like the way we said, duration equal to percentage change in price by percentage change in interest rate. So for that, what did we said? Percentage change in price is equal to duration times the percentage change in the interest rate. This is what we came up with. Now when I bring in the convexity, because it's a second order stuff, we'll put it as convexity into percentage change in interest rate squared into half. This is what I bring it with the convexity. So the percentage change in price actually becomes duration into percentage change in interest rate. Duration here I have to take it as negative, minus duration into percentage change in the interest rate, plus convexity into percentage change in interest rate squared into half. This is what will be the equation for finding out my percentage change in price in case the duration as well as the convexity are given. If only the duration is given, I will simply go with this. Even if the convexity number is given, then I will have to go with this kind of a calculation. right? So just let's look at the numerical, which will give some kind of clarity. $150 basis point increase, which is 1.5% increase or decrease. So duration is 9.115. Convexity is 114.8. Now if I want to find out the percentage change, if the interest rate falls by 1.5%, okay, let's take falls by 1.5%. So the percentage change in the interest rate is duration. So here the duration I will take everywhere. It's better to take for if convexity is present, better take the duration negative directly. Otherwise it will have its impact. Right? Better take, because convexity is always positive, duration is always negative. So when you are trying to add up, you should add up properly. So here, okay, equal to duration times minus 1.5%, because interest rate change we are assuming it as minus 1.5%, plus convexity into minus 1.5% square, the interest rate square, into 0.5, half. This is what will come out as my, so the percentage change in the price if the interest rate falls by 1.5% is 14.96%. If I had ignored the duration, convexity, what would have been the prediction? Duration times this much. So it is only 13.67%. So I would have ignored almost 1.2 or 1.3%. I would have underestimated the price. I would have underestimated the price by almost 1.3%. Similarly, if it up by 1.5%, the same logic goes. Duration times 1.5% plus convexity times 1.5% square times 0.5. So this is becoming 12.38% down. So if the interest rate goes up by 1.5%, the price will come down by 12.38%. If I had not taken the convexity, the price would have come down even by same 13.67% itself. There also I would have underpredicted the price. So both in case of positive as well as negative, if convexity is not taken into account, the price goes underpredicted, because always the duration line we have seen is like a tangent to the curve. So the price is always higher in case of positive convex. Whereas if there is a negative convexity, if the graph is more like this, the duration will be like this, the tangent to this curve. So duration will predict the price more than the actual. In case of negative convex, we'll always see that the duration will do an over prediction of the price. In case of positive convex, we see that the duration will under predict the price. Right? Yeah. Then the one more thing as a part of this is the different theories regarding the term structure of the interest rates. So here this is nothing but the long term versus the short term rates. What would be the kind of the structure associated with those kind of rates, and how do I see whether the long term, see if I invest for long term versus short term, should the long term rates be higher compared to the short term, or short term rates be higher compared to long term, or vice versa. So those kind of stuff, they are driven by a couple of theories, typically called as the different theories of structures of the interest rates, how the interest rates are going to be different between short term and long term. So the first one, the expectation theory, is simply saying depending on what people expect in future. If people expect that the interest rates are going to go up, the long term rates will be higher compared to the short term rates. If they expect that the interest rates are going to go down, then the long term rates will be lesser than the short term rates. It's purely based on the expectations. So the future rate is always the expected spot rate. Right? What you are expecting as the rate, using your various mathematical models or whatever it is, right, depending on the pattern observations in the past or whatever be the mechanism, how do you expect, based on what you expect the rates to be in future, your long term rates will be higher than the short term rate or lower than the short term rate. Now probably if you see, this is the point where we are seeing if you deposit for long term, you will get a lesser interest rate compared to you depositing it for a short term. Because the people's expectation on the long term rates is they will fall. Because the economy has to be balanced. Some economic activity has to happen. So only when the interest rates come down, the economic activity can start picking up. So if that's the case, there is a solid expectation that the interest rates are going to go down in the coming years. So just again going with our long term rate, which is nothing but short term rate multiplied by the forward rate. So because and if there should not be no arbitrage, there should not be any arbitrage in the process. So that's where what happens, the long term rate will be lesser than the short term rate in case there is an assumption that in the future the interest rates are going to go down. So it's basically based on the expectations of the various investors or various players in the market. If the expectation is that in the short term, that in the next few years the interest rates are going to go up, the long term rate will be more than the short term rate. If the expectation that in the future the interest rates are going to go down, we see that the short term rate will be more than the long term rate, and vice versa. That is what is the expectations hypothesis theory saying. It's simply saying it is purely driven by the expectations of the investors, how they are viewing the near future. Again, it may not be their gut feel based view, right? It is again a part of the economic view. If the economic activity is getting hampered, recession is too much, in all these cases probably I may get that interest rates have to come down so that at least some kind of economic activity can be initiated in the economy. So unless the interest rates come down, no one will borrow, and if no one is borrowing, economic activity cannot happen. Right? So that is the expectations theory simply saying. Then the liquidity preference theory is saying, yeah, expectations are fine. But what is the advantage for me to hold for long term if long term and short term give the same? Why should I block my money for long term? Unless there is something extra I get, some extra benefit I get, there is no point in blocking my money for the long term. So what it says is, apart from the expectations, there should be some premium for blocking your money for your long term. See, if you are saying 1 year deposit versus 5 years deposit, you are actually locking your money for 5 years. You are giving an assurance to the bank that they can use the money for 5 years. So what is the advantage? Probably you could keep it for 1 year, then again for 1 year, then again for 1 year, for 5 years like that. But what is making you to put it for full 5 years at a stretch? Unless they give some extra premium for holding it for a longer period. So liquidity premium theory simply says, because you are locking your liquidity, you are getting locked, your liquidity is getting blocked because you have invested for a long term right now, there should be some premium which you should be getting. Apart from the expectation, see, if the expected hypothesis as per the expectations, let's say the interest rates are going to go down in future. So probably based on that, let's say the short term rate is 8%, the long term rate, let's say, is 7%, because there is an expectation that the interest rates are going to go down. But what the liquidity premium says is, there should be some premium for holding it for longer term, which means it's not 7, probably it may have to be 7.25% or 7.5%. So the 7, coming up to the 7 is purely based on expectations. But because there should be a differentiation between blocking your money for longer period versus shorter periods, the longer period means you are exposed to some extra risk. What if the company or the bank closes its operations within the 5 years? You are exposed to slightly more risk compared to the other person who is invested for only for 1 year. So if you are exposed to more risk, you have to take more return. So that's what it says. If at all that liquidity has to be given some importance, there should be some premium that a guy who has blocked his money for long term should typically get. So liquidity premium theory says, whatever may be the expectations and whatever may be the expected long term value, on the top of that there should be a premium amount for holding that particular or for locking the money for a longer period in that security. That is what is being conveyed by the liquidity preference theory. Then we have the third one, an interesting, which is the market segmentation theory, which simply says the rates. It is almost contrasting the expectations theory. The rates, short term, long term, they purely depend on the demand and supply for long term or short term money, not the expectations about the future. How the money requirement goes, or how the investors, for what periods they are investing and who are the significant investors. For example, if I look at a pension fund company, they generally invest for 20 years, 25 years, long term, because most of the time the payment has to be made to the participant only on his retirement, which could be probably 15-20 years at least minimum on an average. Similarly, insurance company, a life insurance company may generally invest for a longer term. Heavy portion for a, depending on how its business is going, what kind of customer profile it has attracted more, it will have a longer investment versus a shorter investment. Similarly, on the other side, a mutual fund company may make its investments for a 3-year to 5-year period. So different types of investors, they have different time horizons in terms of investing as a part of their business itself. There is no point for a pension fund guy, pension fund manager, to invest for a 2-year period. Literally, there is no use for it. Unnecessary transaction costs are building up. So his intention will always be a long-term investment by the very nature of the business itself. So what this theory says is, depending on what is the demand for long-term versus short-term investments, right? Are the investors more preferring long-term investments by the nature of their business itself? So if more pension funds are investing this year, then there is a lot of demand for long-term funds. If more mutual funds are investing this year, then there is a demand more for short-term funds. So depending on which ones are investing heavily in the coming year, there will be a demand, or there will be a heavy or a less demand for those kind of maturity instruments, and depending on that, the interest rates will either rise or fall. And so the future long-term interest rates, it says, okay, expectations one side of the story, right, which is a different funda altogether, that okay, if the interest rates are currently high, they will come down. That's a typical expectation world. But this world, the market segmentation is simply saying it's purely going by the market. You segment the market, who requires what kind of investments. So if there are more and more buyers looking for long-term investments, there will be a more and more demand for long-term investments. So long-term interest rates may come down. Similarly, then the short-term may be much higher, and vice versa. So the market segmentation is more doing from that perspective. From a market standpoint, depending on the demand associated with these investments, the short-term and long-term interest rates are dependent. So these are the three key theories. This is even called as preferred habitat theory, the market segmentation. So these are the three key theories that are driving the forecasting of the interest rates, long term versus the short term. Of course, the first is a very basic one. The liquidity theory just adds up to that. Whereas the third one, market segmentation, is a different picture altogether of the short term versus the long term interest rate. So while building the models to predict or forecast the interest rates, people build these kind of information into those models, right?